What's up everybody? Dan again, stocktrades.ca. Welcome back to the channel. You'll notice that we typically publish on Tuesdays. It's Thursday today. We're a little late with this video, but we spent a lot of time over at stocktrades.ca updating our top dividend stocks page as well as our top renewable energy stocks page. So if you want to have a read of those, I'll leave a link at the top of this video and also down in the description. But for this week, we're solely focusing on subscribers and readers' questions, whether they be about an individual stock, about a stock strategy, an investment strategy, something you're looking at right now, or a burning question you have in your mind. I'm going to answer it today, so let's get started right now. So, spoiler alert for the questions. Our last question is probably going to be one of the most critical questions for investors to know, and something that we get asked all the time, and that is when to sell a stock. So, if you want to know the answer to that question, what we do here at Stock Trades and how we manage our stock recommendations over at Premium, stick around till the end of the video and you're going to find out. So the first question we have is from Nathan Grimard, and he asks, is dividend investing a viable strategy for a 19-year-old? I've seen so many YouTube videos where they recommend to take more risk due to the larger time frame, but compound interest with a drip works best at a young age. I have around $27,000 invested, but I'm all over the place with no clear strategy. I have another $10,000 sitting on the sidelines that I won't touch before I get the strategy situation sorted out. Here's my question. Do I have to pick either growth over dividends or vice versa and only focus on one, or can I do both? If so, which one is better to hold outside of my TFSA? So for one, any YouTube channel that is recommending a specific strategy for a specific person is probably not a channel you want to follow. Investing all depends on your own individual risk. The only thing a 20-year-old with a very low risk tolerance will do getting into a growth strategy is make mistakes, and eventually will lead to panic selling and a loss of their original investment. If you can't handle the risks that growth stocks present to an investor, then you shouldn't be investing in them, regardless of your age, regardless of their time horizon. In this March COVID crash, I am sure there was a lot of young investors who thought they had a high risk tolerance. I mean, it's pretty easy to have a high tolerance for risk when we're in the longest bull run in history. During a bull market, it's pretty hard to be wrong. But when everything comes crashing down, that is when those who think they're high risk are really not that high risk, and they end up selling off their holdings, and it can take them years to make their money back. In terms of asking whether to pick growth over dividends, you can do both. I do both. Right now my portfolio sits at around 60% income and dividend growth stocks and 40% pure growth plays. Over the last few years, I've made quite a bit off three plays in particular: Shopify, Canopy Growth, and Canada Goose. And at the end of the year, I essentially just sell these positions and I feed them back into my income portion of my portfolio. And typically on an annual basis, it will always be 60% dividends and 40% pure growth plays. Somebody who's holding 100% stocks is prone to significantly more volatility than somebody else. My portfolio is 100% stocks, and I lost a matter of, I think it was 41% in 19 days during the COVID crash. But the one thing you really have to understand before you ever make any investments, determine your risk tolerance. Don't watch any YouTube videos to say what your risk tolerance is and what you should be investing in. This is all the investor himself. You'll only get into trouble listening to others because only you know your financial situation, you know your risk tolerance, you know how much you can handle, you know when you'll need the money, things like that. So the next question is from Peter, and I'm sorry Peter, I'm not going to try and pronounce your last name because more than likely I'd get it wrong and embarrass myself, but Peter is asking, what do I look at when analyzing dividend paying companies? And for one, the yield is one of the last things I'll look at when analyzing a dividend paying company. First, I'd like to see dividend growth. I like to see, at least the company at least being a Canadian dividend aristocrat, if not a decade-long dividend growth streak at least. And I'd like to see double-digit dividend growth. It depends on the industry. A utility company I own, such as Fortis, they're not going to achieve double-digit dividend growth. I know that. They're around 6%, but the fact is they've increased dividends for 46 years. So I really don't mind that dividend growth, especially in a sector as safe as utilities. But you want to see reliable dividend growth and you want to see long dividend streaks. Now, in terms of payout ratios, a lot of investors get tunnel vision and they look at the payout ratio in terms of earnings only, which is actually a huge mistake. So I look at 3 payout ratios, and in terms of importance, I would actually put payout ratio in terms of earnings last. We want to look at the payout ratios in terms of free cash flows and operating cash flows. This is going to give you a broader scale of the safety of the company's dividend. If you're just looking at earnings, especially with a company, for example, Enbridge, they have a very high payout ratio in terms of earnings. But if you look at operating cash flows, you're kind of going to find that their payout ratio is very sustainable, and that's the reason why the company has raised dividends for 25 plus years. You wouldn't believe the amount of people that have spoke to us and are worried about the safety of Enbridge's dividend because they see, a 120 or 130% payout ratio in terms of earnings. So in terms of dividend growth, you want to see a company that is increasing or at least maintaining dividend growth as per its historical averages. If a company is increasing its dividend over the past 5 years by 10%, but over the last 3 years that dividend growth has shrunk to 6%, 5%, 4%, you really need to start looking deeper and figuring out why this company is having to slow its dividend. Is it a cyclical industry? Is the company starting to see shrinking earnings? Are we in a recession like we're in now? A lot of companies right now are not going to be able to raise their dividends in this pandemic as they would have before. You can kind of take a flyer out on this pandemic. I think a year from now or a couple years from now, a lot of investors will understand, this was unprecedented times, so they'll forgive a dividend growth halt, or a lower dividend growth rate. But overall, you want to see a rising dividend growth rate, or at least on par with historical averages. And finally, although you're looking for dividends, you still have to remember these are still companies you're buying. These companies need to make money, they need to be profitable, their share price needs to increase. You can grab a company with a 6% yield, but if they're losing 5% of their stock price on an annual basis, it's not really that good of an investment. You're earning 1%. So you need to find companies that are poised for growth in terms of stock price as well. There are so many people that will overpay for a high yielding stock, and then when the bottom falls out and eventually maybe even the dividend gets cut, then they're in a whole world of trouble. So, email question next, and it's probably one that I've gotten 1,000 times since starting stocktrades.ca, and I'm finally going to answer it. I have in individual emails, but I'm finally just going to put it out there, and they want to know what are the top 5 holdings in my portfolio. I'm just going to give you the top 5 holdings. I know a lot of people want me to go over why I like these stocks and why they are the top 5 holdings in my portfolio, but this video would probably run on for an hour and I want to get on to other questions. So top holding in my portfolio currently is TFI International, and the company actually has a 14.5% stake in my portfolio right now, which is pretty high. I will end up doing some rebalancing at the end of the year and selling some shares off. But this was a stock that we recommended to premium members that did very, very well. They fell down to around $27, I think it was during the height of the COVID-19 pandemic. And as a trucking and logistics company, we knew that there was not going to be much happening to this company. It was going to be business as usual. So I ended up lowering my average cost down a ton. We sent out some emails to premium members saying, hey, this is something you really need to look at right now. And as a result, it has bloated inside my portfolio. My second largest holding is Lightspeed. This is a point of sale company, and this is another one. They have a very large portion of my portfolio right now because COVID-19 caused that stock to crash. I think at its lowest point, I was getting shares for $15 a piece. It was absolutely crazy. So my third largest holding is TELUS. T.to. This is my favorite telecom company in terms of 5G exposure. It's my favorite telecom company in terms of telecom. I mean, they're a pure play telecom company. It's not that I don't like Rogers. Well, I don't like Rogers. They stalled their dividend growth. That was pretty much a deal breaker for me. But I don't mind BCE, but their media divisions, I mean, I like going with TELUS because, like I said, they're more of a pure play, and they're also getting into telehealth, which I feel will be a higher ROI business than, say, a media division like BCE and Rogers have. Fourth largest holding, Fortis. This is another one that I had been averaging down in during the COVID-19 pandemic. This is an excellent utility company. They're probably one of the best utilities in North America. 99% of earnings from regulated utilities, which essentially means they own the poles, they set their price with the municipality, and they make money regardless. I think Fortis is one of the best stocks to own in the country. In fact, with our recent dividend update, Matt put it at the #1 dividend stock to own in Canada. Fifth largest holding, Royal Bank of Canada. They, in my eyes, the best bank in the country. One of the best banks in the world, for that matter. In terms of exposure, they have the highest global exposure, and that is why I think they're only down around 4% post-pandemic. Scotiabank used to be the bank with the highest global exposure, but they've generally failed at synergizing this, so RBC has taken over. They smashed earnings out of the park recently, and I have been averaging down heavily in all my bank stocks. I think at this point I own a total of 18 stocks. The only big bank that I don't own is CIBC, and the only bank that I really regret not purchasing is National Bank. But there you have it. Those are the 5 largest holdings in my portfolio. At the end of the year, TFI will probably not exist in this category. I plan on selling some of it off. It's just the recent surge in price that has really brought it into this category. So next question, and we're going back to the YouTube questions. Aswin asks, do you guys buy regularly regardless of market price, which means buying even though it's expensive? Or do you wait for when the market goes on sale before making your purchase? And before COVID, this would have been a very easy question for me to answer. It probably would have taken me like 20 seconds. And the answer would have been yes. I pick a certain amount of stocks every month, and I buy whatever capital I have in my account. Dollar cost averaging, especially if you're paying commissions, you need to kind of adapt your strategy. So for example, if you had $12,000 a month to put into an account and you own 12 stocks, then yeah, it's pretty easy to say you could buy all 12 every single month. But nobody really, I mean, if you have that kind of disposable income, congratulations. Not a lot of people have $12,000 every month to be buying stocks. So say you only have $1,000 and you still own 12 stocks. You might want to do it this way. You put $1,000 in January, you put $1,000 in, pick 2 stocks, buy $500 each. In February, you got another $1,000, pick 2 other stocks, buy $1,000 each. By month 6, you'll have invested an average of $500 into all 12 of your stocks over that 6-month period, and then just restart the cycle. In my opinion, burning more than 1% of your total trading costs in terms of commission. So for me, Questrade, I have to make a $500 purchase to justify the $5 commission. It's really not worth it. But if you have commission-free trading, then realistically, if you had $600 and 12 stocks every month, you could put $50 in each stock. And I think dollar cost averaging really only works when you don't really look at the prices. You just buy evenly. That's why you're dollar cost averaging. You can't get scared that, oh, why is this stock really low right now? I'm not going to buy it. Why is this stock really high right now? I'm not going to buy it, because then you're not really reducing the overall volatility. I mean, I get it if a stock is absolutely absurd. Like, for example, I stopped dollar cost averaging Suncor and Canadian Natural just because of the situation. And I also, back when I owned it, I stopped dollar cost averaging Shopify. So there is certain places where I won't dollar cost average. But in terms of dollar cost averaging in the COVID-19 pandemic, do I do it equally weighted? No. I've essentially, like I said, cut off all dollar cost averaging in terms of my oil stocks, and I've heavily increased my averaging strategy into my financial stocks. Stocks like Manulife, TD, BMO, Royal Bank, Bank of Nova Scotia. But normal market conditions, unsure of really when we'll get there, I would go back to a strategy of essentially taking a certain amount of money and purchasing a particular stock to the point where at the end of the year, I've allotted the same amount into all of them. So the next question, YouTube question again, is from Shafon Thomas. And this is something that I have taken a lot of heat on over the past couple weeks. And don't worry, I'm used to taking heat like this. I kind of laugh it off at, a 3-week timeline when people come to me and tell me how wrong I am over the span of 3 weeks. But she says, in one of your previous videos, you said not to invest in Cineplex. But Hollywood is releasing movies here rather than the US, such as Tenet. And more movies are scheduled to release, and Hollywood is still continuing to make movies, and there's no reason to suspect that Cineplex won't host them. Also, big movies like Avatar are coming in 2022, which is a movie made to be seen on the big screen and not through a streaming service. So do you think Cineplex is safe to invest in? Also, what are your thoughts on Lightspeed? I'm not going to speak much on Lightspeed. It's featured heavily on our premium end, so I don't talk about it much here. But Cineplex, my opinion is still the same. I really would not invest in this company right now for the long term. When I look at a company, I'm looking at 5+ years down the road. I know, like I said, I've been told I'm absolutely wrong in a 3-week time span because the stock price has gone up $1 because movie theaters reopened, which I'll explain in a second is really not what you think it is. This company is going to struggle. It is clear that there is a shift from a cinema style experience to a home style experience, streaming services. I mean, these theaters were hurting before COVID-19, and now they're hurting even more. Probably a couple weeks ago, I went and seen Tenet. Me and my girlfriend, when we walked into the theater, I could count on one hand how many people I seen in the lobby. And when we got into the theater, I'd say Tenet, and I think it did release for, I don't know, not very long, but there was 10 of us in the theater. So if every group of 2 spends $50, that's $250 they've made to showcase a blockbuster movie, which, by the way, was not very good at all. Very hard to hear. I would not suggest seeing it in a theater. I'm going to have to rewatch it with subtitles, to be honest. These companies are going to struggle. It's clear Cineplex burnt through a ton of cash last quarter. They had to issue a debt offering, which should allow them to survive. They are going to survive this, but ask yourself, looking at the situation right now, would you feel comfortable holding Cineplex 5 years from now? If you want to make some short-term trade, that the news or an increase in revenue next quarter boosts their share price, sure. But my outlook is looking further than a year down the line. It's looking 3, 5, 7 years down the line. I don't want to hold Cineplex 5 years from now. That's my opinion. It's probably not going to change. I probably would have said this pre-COVID. So the next question is from G Tom, and he asks, what do you do in a market sell-off? I'm going to speak on what I would do in a market sell-off because I have no idea what stocks you hold, how your portfolio is constructed. It's different for everybody. I mean, if you hold bad stocks, you're going to struggle in a market sell-off. If you're holding high-yielding stocks that are teetering on the edge of a dividend cut, chances are the COVID crash did you in. I mean, we had the most dividend cuts we've ever seen in a short amount of time. And there's a chance, if you bought that 9% yielding junior oil and gas company, you might never see your initial capital again. So in that case, during a market sell-off, I probably would have told you to sell your holdings. But I don't know what you're holding. So for me, I did nothing. My portfolio, as I said in the start of the video, 19 days, it dropped by 40%. I remember I was on vacation in Nashville when this whole thing started to crash, and I watched every day as my portfolio just collapsed. I had never seen anything like it, so even for me, it was a little bit nerve-wracking. I can't imagine the amount of people that sold their holdings off. But in the end, the market always recovers. It has every single time before, and it will now. It already has. This is the quickest recovery we've ever seen. Now, is it overdone? I would say yes, but I'm still not going to sell my holdings because I buy strong companies. Fundamentally, there really isn't anything that changed besides, say, a company like Lightspeed, which I was able to take a little more risk on, averaging down during the height of the pandemic. But why did I take that risk? Because I knew how to analyze the company. I looked at them. They had, I think, $240 million in cash. And I said to myself, this is going to be really rough for them in the short term, but I know they're going to survive this. A lot of people didn't even pay attention to that. They obviously thought, Lightspeed, ton of their revenue comes from the restaurant sector, sell your shares. Meanwhile, I scooped them up at, $15 at sometimes, because I just understood the companies I owned, and as a result, I didn't sell any, and I averaged down significantly on a lot of my holdings, and now I'm actually in the green. So, last question, and quite possibly the most critical thing you need to know as a self-directed investor, if you don't want to lose money, that is when do you sell a stock? And the thing is, this is such an easy question to answer, and it stumps so many people. But the only way the answer is easy to this question is if you do the preceding steps correctly. If you want to know when to sell a stock, when the right time to sell a stock is, you need to know why you bought that stock in the first place. If you're looking at an income-paying company and you like the company because they're paying a high yield and they have, a 10 to 12% dividend growth rate every year, that's why you bought the company. I mean, don't get me wrong, it goes a lot more in-depth than that, but when would you sell that stock? Well, if you bought that stock for dividend growth and, say, a pretty good yield, if the company cuts the dividend, do you still want to own that stock? No, your investment thesis is changed. Or if the company still holds their dividend, but they stall on growth, or they, for the next couple of years, they only post 5% dividend growth, that might be enough to say, hey, I better move on and find another company that provides what I want. The only issue why a lot of new investors don't know the answer as to when to sell a stock is because they have no idea why they even bought a stock in the first place. Take two investors, for example. One did a detailed analysis on a company, developed an investment thesis. They know why they bought the stock. They know when they need to sell the stock if things change. And you have a second investor who went on a message board or a Facebook group and bought a stock because everybody told them to. Who do you think is going to know when to sell? So, how do you know when to sell a stock? Well, next time you buy a stock, and even for the holdings you have now, if you don't already have it, open up a Word document. It doesn't need to be that extensive, but you need to jot down the reasons for buying the stock. And next time the stock takes a dive, or next time the market takes a crash, you can look at all your holdings, you can refer back to the reasons why you bought. If nothing has changed, then you just don't sell. So I'm pretty much going to wrap it up there. If your question wasn't answered in this video, don't worry. We're going to do a lot more of these. But I hope that you like this video, and if it helps you out, share it on social, share it wherever you can, let your friends know about the channel, and most importantly, like and subscribe to stocktrades.ca YouTube channel for more great Canadian content. Till next time.